hello again. Welcome to the Marc Oslar Retirement Experience. My name is Randy Cook, and each week Mark and I sit down here and talk through some of the issues of retirement. And today, the first topic will be summertime. We actually made it to June. Here we are in the summer, and things are nice and easy. And are we thinking about our retirement? Are we thinking about our finances? We'll talk a little bit about that today. But Mark, summertime is here. Kids are getting out of school. It's a fun time of year, isn't it?
It is. I really enjoy this time of year because I still have two young kids. You know, I have two older ones. My oldest one, Ariana, she works with us. My second oldest, Callista, she's still at ECU. She's got another year left. And then our youngest two are 13 and 9, Finley and Stella. And they're just, I want to spend some summertime with them,
Yeah. As a parent, sometimes you get, I've only got, like 7 years left of this before they go off to college or something like that. And you got to make use of that time. And I mean, we talk here on the show about retirement where you're making use of that time as well. You've planned so many years for this, and now's the time to really enjoy it. And can you enjoy it with all the worries that go with it? So that's kind of what we talk about here on the show. And that's kind of where we're actually going to start today, Mark, because, as you get toward retirement, you got all this money in your 401ks. You can't help but look at the stock market, and the market's going up and we're doing pretty good here. But Mark Zandi, who's an economist that's been watching the markets for over 30 years, almost 40 years, actually, and he works for Moody's, and he said he's never seen a time when the stock market and the economy are so disconnected. They used to kind of go hand in hand. Market's up, economy's good. Market's down, not so much. But that doesn't seem to be the case right now. But as I said, a lot of people have money in the market in the form of 401ks. So if the stock market is not a good indication on the health of how your retirement is going to do, what is a good gauge to say my retirement is on good footing? Where do we go?
Truthfully, when I see this, and this is hard for me, Randy. I'll put this as plain as day. We've discussed this before in the past, but what is the number one detractor of interest rates or maybe the potential of a market decline? Well, let's look at it. It's geopolitical risk. Mm-hmm. Where are we at right now? When I do a presentation, we talk about several things. And one of the things I talk about and I highlight on right now is the potential of war, right? Mm-hmm. And here we are. We've got Israel, Iran, and the U.S. is smushed in between. Mm-hmm. Okay? So when I see this and I see this occur, well, sure, there's some good things that are occurring in the sense that, maybe some interest rates have ticked up. Maybe it's been good for some insurance products, some annuity products for just pricing things. Great. But overall economy, not necessarily. The market's shooting up like crazy. If you look at tech right now, you know how tech usually gradually goes up, but it's definitely a little bit more volatile. Like Nasdaq's more volatile than S&P, but it'll shoot up, right? It's shooting up like a straight arrow straight up in the air. Mm-hmm. This is a tell sign. Okay, what is it telling me? Well, when I look at it, I compare that, and then I compare the information I'm getting from folks. Have you read recently that Amazon is talking about how people are not renewing their Prime membership? Now think about that. Is that because of lack of funds? Yeah. There's a lot of families out there hurting right now because of the massive inflation, and the massive inflation is occurring even on top of the previous massive inflation because we're in a war, and that's what's occurring. And then the market is really no indicator about how families are feeling out there right now. So that's why we need to be cautious, and I'm always cautiously optimistic about the market as a whole for the long term because we always want to grow your money, but the question is that what's best for you if you're getting close to retirement for all of your funds? And that's the real conversation.
So market is up. My retirement should be good. Those two things probably shouldn't go together, because if you're dependent on a stock market to have a good retirement, that probably is not where you want to push your chips. So what we talk about here on the show, Mark, is how do I get paid? What is my paycheck going to be in retirement? Make sure that money's coming in every single month. That, to me, seems like a better indicator. If you've got that in line, that seems like a better indicator as to how your retirement's going to go.
Yeah, and that's the thing, Randy. So when I look at this and I try to understand where a person's going with this, I have some serious concerns because you're talking about 401ks, right? Mm-hmm. We're discussing 401ks. I just met somebody recently and they got laid off, and the majority of their money is their 401k. Is there anything wrong with that? No, not necessarily. But here's the thing. Now that you're laid off, can we do something about that? Can we affect this transaction in a way where if this person tells me they've got 5 years of work left in them after they get another job, how do we prepare them for retirement? Well, I don't think it's keeping it static in a 401k that's limited with their options of how they diversify their money, how they grow their money. I mean, even you run a Morningstar report on that particular 401k, and it seems like it's coming well short of the benchmark. This should be a question we should ask ourselves. If you have a 401k, if you've been laid off, if you have a job and you're 59 and a half or older and you have a big 401k, how about I run a financial report for you? Go to my website, moreToRetire.com, scroll to the bottom of the screen, put your information in, tell me you want to talk to me about some stuff, and then go to the front page. In the top right-hand corner is a secure upload button. You can send me over your 401k stuff. It comes securely. We'd be glad to run a financial report for you and identify how it's performing against what you could do differently. And we'd be glad to share that with you, because I'll be honest with you, with market conditions being too static. When I say static, I mean, yeah, we're solely focused on how S&P's moving or how NASDAQ's moving. And our correlation, which is everything moving in the same direction, seems it's like S&P or NASDAQ. These are the conversations we need to have now, because if there's a correction, you don't want to correct like a 2000 to 2002 or 2007 to 2009, where people were calling their 401ks 201ks because they fell in half.
Yep. We've saved for retirement. I bet a lot of you're listening to this show and you've saved well. You've done a great job. You've made those sacrifices, and it's a nice nest egg. And it's all in 401k money, perhaps, and maybe it's Roth money or savings. And you wonder, how is this all going to power my retirement? I've got my Social Security. Maybe you've got a pension. That's fantastic. That's another check coming in. What does this other stuff do for me? And that market scares me because it goes up and down. And I worry about that kind of thing. Well, let's get that out on the table. Let's talk through that. Give Marc a call. Take a look at the website. It's pretty easy. More2retire.com. Just spell that right out. More2retire.com. There's a place for you to put a little information in there, as Marc said. And our team will reach out to you and sit down and talk through your questions about retirement. Maybe it leads us to getting something down on paper. Do the math on your retirement. Here's the number. It's 984-300-1984. That's a no-cost, no-obligation meeting. So here we are. We got a little summertime. We've got some time to sit down and actually think about these things. Take an appointment, take a day, and say, okay, what is my retirement going to look like for the next 15, 20 years? Here's the number again, 984-300-1984. So at the same time that the market is going up, and a lot of people are kind of giddy about that, they talk about that K-shaped economy that we have. Some people are doing really, really well, and then other people are not doing so well. We're also seeing headlines about layoffs and all sorts of different things like that show the other side of the economy. And some of the things that we're seeing out there is companies are laying off. Other companies are not doing that, but they're cutting back in other ways. One of them is cutting back on the match on their 401k. They said, we're just going to suspend that for a while till we get to the other side of this. Well, if you are in that situation, you're in your 60s, you're still in your 401k, you're getting your match, that's why you're there. Marc, should that signal something to you and say, maybe I shouldn't be in this 401k program and maybe I should be pushing that money into something else as I get toward retirement? What would you counsel somebody like that?
Yes, yes, and yes.
Okay.
I mean, I'll be honest. They're going to stop matching
that
a
hurts.
401k?
Yeah.
What is the incentive? You know, you tell me you're giving me a group of different funds that you're going to offer me to invest in, and then you're going to recommend, if I don't know what I'm doing, to go into a life cycle fund. And then you're going to tell me you're not going to match what I put in there. Forget about it. I might as well go do a Roth IRA. If I make too much money for it, I could do a backdoor Roth where you contribute to an IRA and then backdoor it where you just basically convert it to a Roth IRA. I might as well start talking to Marc Oslar about a life insurance policy if I've got 10 years of work left, because a life insurance policy, you can overfund it, stay underneath something called a modified endowment contract limit, and you can have something similar to a Roth IRA on steroids. So what's the real conversation we're having here? if the employers are stopping the match and Amazon is saying people are not renewing the Prime membership, and now you're starting to see some streaming companies putting the clamps on saying, nope, you got to pay for this person, this person, this person. And then people are dropping services because they can't afford it. So it's not just the employees hurting, it's the employers are hurting too. And we're talking about an economy that's not matching what the market's showing us in those huge, huge returns.
Yeah, I think at this point, when you're in your 60s, you're kind of wondering to yourself, should I still be in that 401k, or should I push everything over to the Roth 401k, or maybe I should be out of this thing altogether and start putting money into something else? What is the something else? And well, this is the show where we sit down and say, all right, let's discuss those options. What is the something else? That's a conversation with you and Mark. That's a conversation to look at options of where your money should go, where your money could go, what the purpose of your money is, what do you want to do with this money? There's a lot of questions there that I'll bet you have. Let's get those questions answered. Sit down with Mark. Here's the number. It's a no cost, no obligation meeting. Really what this is, it's a conversation to say, here's what I've done for retirement. Here's what I want to do in retirement. Here's when I want to retire, and just get all that out there and just talk about what your retirement will look like 5 years, 10 years, 20 years, 25, 30 years into the future. Here's the number, 984-300-1984. 984-300-1984. Give Mark a call and let's have that meeting. Or you can go to the website, which is more2retire.com, more2retire.com. All right, this article in Investopedia broke down how and where retirees get their income from, what the purpose is here. This is kind of interesting. So you figure, I don't know what it is going to be. So let's say $6,000 a month. Okay, where does that come from? 30% of it overall comes from Social Security. This is interesting. 27% comes from earnings. So people in retirement are doing a little part-time work. That's helping. 23% comes from either pensions or savings. So there's the bulk of it right there. This was really interesting to me. 12% asset income. We'll get to that. And then 8% other sources. So 12% of their income is making more income. Only 12%, Mark. That seemed like a really low number to me of how much is dedicated toward growth to get income in retirement. Is that a low number to you?
Yes.
Okay.
And that's not a number as an advisor that I would promote when I'm trying to help somebody retire.
Okay.
Okay, so let's be as clear as day. Let's say you work with a Fisher Investments or you work with another group and they basically have all your money in the market, different positions, depending on how you want to accomplish it. Maybe it's just, with Fisher Investments in particular, they're always looking for growth. And then they tell you, well, look, they're good at it. And then they tell you, look, okay, so we'll set up some provisions for you to pull some money out. Sure. What does it say at the top of the statement? It says wealth management. Okay, I want you to understand something. I'm not your typical wealth advisor. I am a financial advisor who also practices in the insurance side of the business that does annuities, life insurance, long-term care. But yes, we are on the fiduciary standard of care of the business on the money management system too as well. And so what do? We work with clients to figure out what's going to be the most effective way for them to retire. And the question is, do they want some preservation tactics built in? And no, we prepare your assets for income in retirement because we want you to know that since you don't have one of those jobs from back in the day where maybe you have a pension and you don't have that luxury of having a pension and you rely on Social Security and you're worried that Social Security could reduce by 28% in the future, then this is what we do. We prepare your assets in this format, and we'll stand by this. Preservation, income, and growth. It's the acronym of PIG. We preserve what you worked your whole life for. We build in an income strategy that's based on preservation tactics. We prepare for taxes and inflation with preservation and income. And if we do that with the portion of money you need for your assets, which is definitely going to be greater than 12%, then we can affect the rest of the money in a growth pattern. That's when we can look at the wealth management, and it just depends on what your risk tolerance is. But that's what we can do. And if we do that, we know I and you can put your head on the pillow comfortably at night and know that the income is going to come, and you don't have to worry about is it going to show up or not? Is it probable or is it expected? And I want it to be expected for you. So the intention is that we're going to do it this way.
This is kind of the difference to me of having a retirement financial plan and not having a plan. Is maybe you've saved really well. We'll just save you've saved $1 million. Fantastic. So you say that ought to be enough. So I'll just take it as I need it. And we're going to get into that in just a second here. And that is really not an income plan. Mark, you talk about this all the time. That income portion of it is your money making money, or something within your portfolio that is paying you like a pension. It's kicking off income. And that's a big difference between somebody just peeling money off the top as they need it.
And that's the thing. From a wealth management perspective, you're just going to grow the money and then just cut the checks as a person needs money. But what if the market corrects? Mm-hmm. And we talked about this before as well, Randy. We've discussed this, right? If we discuss sequence of returns and we take the same returns, okay, let's say you have a positive 25, a positive 32, a positive 2, and then a negative 18, and then a positive 5, and then a negative 16. When you take all these sequence of returns over a 10-year period of time, and you're taking the same amount of money of withdrawals out of that money, but let's just say you jumble up how those returns happen in those 10 years. Column A and column B can be drastically different. And what I like to do is say, let's have our cake and eat it too. What do I mean by that? If you build in the preservation tactics for income, then you know what you're going to have at the end of the rainbow. You know what's going to be available to you for income. You know what's going to be available to you for your asset. And then we can effectively grow everything else because we have time. Time is a key factor. So if we're not worried about taking income from the growth portion, then we can grow it and not worry as much about a market correction. And we can still affect the transactions and obviously be active and actively traded and make sure that you don't correct exactly like the market. But again, if we have the growth portion that we don't need to pull from, then we can grow that properly while we build in all the preservation tactics. And that's the key, Randy.
Got two stats here that I want to make a point here, and that is about 50% of people in retirement do exactly that. They just pull money as they need it. They don't have an income plan. They don't have a spending plan. They just take the money as they need it. And for those of you who are afraid of running out of money, that's how it happens, is that you, and I've seen many studies on this, is that the one thing that's a big surprise to people in retirement is I'm spending more money than I thought. I didn't realize that, I didn't take into consideration taxes, and I didn't property taxes. That's something that comes out of my, my mortgage payment or something like that. And you didn't. Now I've got to do that. And then all of a sudden all these bills come in and you didn't encounter that. And the other thing that I also saw this week was, of all the financial plans that fail, they usually fail because of something that happened in the first 5 years of retirement. And Mark, that's what you're getting to with this idea that you could go into retirement and all of a sudden there's a bad market. You didn't have anything to do with that, but there was nothing in place because you started losing money, but you're still pulling money. And that's the difference between retirement and your working years, is now you're living off that money. You're not shoving that money away.
Okay, so Randy, let's use you as an example. As I've said before in the past, you're not allowed to retire, okay? So we're just not going there right now, all right? But
Okay.
Are you 64?
I am 65. I'll be 66 this year.
Darn it. I can't keep it straight. So if we keep you working to, like 68 or 70, well, we'll just keep pushing it.
Okay,
We'll push the needle more and more. But let's say, for example, you're getting close, right? So
Yep.
when you're getting closer and closer, if you put in preservation tactics in place for your income, for the portion of money you don't want to risk the rest that you worked your whole life for, then you can answer your wife and say, this is what it's going to look like for us when I do finally say I'm leaving, I'm retiring, I'm going to go golfing. This is where the money's going to come from. Do you think that's going to give your wife peace of mind?
You would think.
Yes, that's what we want from our clients, as a husband and wife, to be able to communicate. If you're not married, no big deal. Communicate with yourself and let yourself know where the money's coming from. And if we know where the money's coming from, then we don't have to worry necessarily about what's going to happen or what's going to take place. So again, my whole objective is not to make the most money possible for you right now at this point. Accumulation, That's great. You're trying to make the most you possibly can. But you hit the different stage of retirement or getting close to retirement, you want preservation/distribution, and then we can affect everything else with a growth pattern that we don't withdraw from. But you need an income plan, and that's what we're going to do. We're going to build an income plan, and it could be based on annuities. It could be based on some other things that we use, maybe a high distribution fund, or it could be some real estate investment trusts, also known as REITs. It could be just a fixed income portfolio, depending on what we want to do here. We like to use insurance products when people want the preservation tactics, because I know for a fact that if it shows it in the contract, then you know it's going to happen, okay? So that's really important to understand. But again, we like market money. We like to grow your money. We just don't want to use your money as an accumulation style of money and then pull from it, because that's not an income plan. And I don't want you to fall into one of those positions where if the market did correct, like 07 to 09, S&P dropped 56.5%, that doesn't happen to you while you're taking withdrawals, because it doesn't have to happen to you. You don't have to be that statistic. And I'm not saying that's what's going to happen, but Randy, let's be honest and candid. People are hurting out there while the market's shooting up like crazy, and we haven't had a market correction in 17 years. Perfect storm?
Could be. When you think about it, I always like to say to our listeners, I want you to imagine yourself in retirement right now, okay? A lot of people listening to this show are preparing for retirement. But if you were in retirement right now, the market is setting new records. Do you think you're going on a whole bunch of extra cruises and spending a whole bunch of money and buying new cars and pampering yourself if the market goes up? Probably not. You are who you are. But if the market went down 20%, do you think you'd cut back? I bet you would. I bet you would. And that is not who you want to be in retirement, that the market is telling you how much you can spend. We need to have a plan where you have the money you need for fun, for basic expenses, for all that you need to have your retirement the way you want it to be without looking at that market. I don't want you on a cruise going, holy cow, look at that headline. It says the market just dropped 1,000 points. I got to call Mark, make sure I'm okay. That's not what you want in retirement. Let's get you a plan where you don't have to be that person. You know that money is there to spend every single month. Give Mark a call. Here's the number, 984-300-1984. 984-300-1984. You can also use the website, which is moretoretire.com. There's a place for you to put some information in there. Mark reaches out to you, starts the conversation. It's a no-cost, no-obligation look at your retirement. Let's get the conversation started. Again, moretoretire.com. We're going to take a break, and we're going to come back. There's a conversation about interest rates. Is it going to go down? Is it going to go up? Is it going to affect the market? Let's talk through that one. Coming up next on the Marc Oslar Retirement Experience.
A simple piece of paper. It's something we use every day. For the most part, it does what it's designed to do. It sits there flat on your desk as a placeholder for information. But with a couple strategic folds, suddenly your flat piece of paper becomes an airplane and flies across the room. Your 401k is kind of like that flat piece of paper. It just sits there as a placeholder for your money. Marc Oslar can show you those strategic moves to take your 401k from just sitting there to creating the income you need for retirement. Call today for a free no-obligation meeting. 984-300-1984. That's 984-300-1984. Or online at moretoretire.com.
Welcome back to the Marc Oslar Retirement Experience. Online, moretoretire.com. This is a show where we talk about that time in your life where you're walking away from that employer paycheck. And how do you get paid for the next 10, 20, 25, 30 years in retirement? It's Social Security And then what? Let's talk about the then what here on the show and all the things that affect you in retirement. So one of the things is interest rates, and this makes the market go up and down. There's a lot of economic headlines that go along with this. This is a big deal. Kevin Warsh is now the new head of the Fed. He took over for Jerome Powell. And there has been talk, this guy and President Trump, lower interest rates, lower. And now that inflation has gone up again, the thought is maybe we need to move interest rates up a little bit to fight that inflation. There's a lot of talk about that, and there is now a 50% chance that we're going to see a rate hike before the end of the year. So, Mark, when the interest rates go up, it gives people another alternative to the stock market, and sometimes the stock market goes down because of it. Is there anything that is a bad, a good, a pro, a con to the interest rates maybe going up before the end of the year?
Can you say Kevin Warsh 3 times fast? I mean, I'll be honest. You know what it seems like his last name for me, I'm Oslar, okay? That's
right.
Not an easy one, all right? But well, Warsh, every time I hear it, I'm thinking I'm hearing one of my Massachusetts clients trying to say wash. You know, I mean, it's I can't get it out of my head. But.
Yeah, my wife's grandma, Grandma Ruth, she was always Washington and wash the clothes and she put an R in everything like that. So it does remind me of that. That's for sure.
I mean, my Italian side of the family up north, they'll say Acme instead of Acme. You know, that's another one right there.
We can do a whole show on that one. All right.
Yeah.
All right. Talk to me about rates.
Rates. This is a tough one. So last time I did a seminar, I went over rates and I kind of showed people where, you know, like State Employees Credit Union, I used them as an example. And I showed straight across the board how it doesn't vary much from 6 months through 60 months. It's almost flatlining what it's showing. So then when you look at fixed annuities, the multi-year guarantee annuities, they're higher rates by a decent amount. But, you know, you have to obviously affix the money a little longer sometimes. But I locked somebody in for a 10-year rate the other day, and he was very pleased with the rate he got. When I see rates right now, I don't understand how they could possibly lower rates right now because of the war. I mean, that's the problem I see, because with the inflation and the oil prices and everything else, if you're lowering interest rates, it's because you're trying to combat the potential of a recession. But the question is, can you actually do it? Does it make financial sense to do it? Or could it throw the market into a little bit of a spin? I don't know how to answer that question. I know Trump wants interest rates lowered, but when you're going through inflation at the time, maybe at some point you can lower them. We've lowered them before in the past, right? But at this point, I don't see where you're supposed to lower the interest rate right now.
Well, one of the things about interest rates for those of people who are looking at retirement there are certain products, there are certain financial products like CDs, money markets, bonds, annuities, I-bonds, things like that are dependent on interest rates. And when they go up, this is actually a good thing for people in retirement. You can lock money in for, a year or 6 months or something like that and continue to do that. So there is an upside to an higher interest rate for people planning for retirement.
Yes. Now's the time. Okay. So here's the thing. If you're out there, let's say you got into an annuity several years ago and with bad interest rates, back when it was 2018, 2019, 2020, that product's priced badly and you probably want to move it out, but you don't know how because of the surrender charges and everything else. Well, let me just tell you, because of interest rates of where they are and how things are going, there's products out there right now that have the largest bonuses I've ever seen, where you can get people out of these charges, put them into a better product, a better priced product, several uncapped index strategies, a lot of things you could do differently. Now, if you told me, you came in my office and you said, hey, I got this 40% bonus, or I got this 50% bonus, I'm just going to stop you right there and let you know. Those bonuses are not real bonuses. Those are probably income bonuses or some kind of death benefit bonus that's a payable death benefit, but it's not a real bonus. It's not on your accumulation value. But bonuses have gone up where I've seen some bonuses above 30% that are real bonuses, and it's shocking to me, Randy, because if we go back about 4 years ago or so, I think the highest bonus I saw in the industry was like 12% or something like that. So I've never seen a traditional bonus this high. But the products and their rates and their participation rates are so high. Get out of the old products, get into something new, because you'll have a better opportunity for yourself, a better line of pulling money out if you need to, better growth potential, better for everything. So right now, and if you want to lock in interest rates, multi-year guarantee annuities are a great time for people to lock in interest rates for a longer term to grow that money. You might maybe just let it grow tax deferred, or maybe you're trying to pull income. You're not going to get a better time than now, because eventually when the war ends and things, kind of get a little easier, interest rates will eventually lower, will combat this area, and it won't be like this. But right now, there's never been a better time.
Well, when you think about it and you say, well, that sounds kind of complicated to me, think about this. As mortgage, if you had an 8% mortgage, I had an 8% mortgage, and then interest rates went way down, and then I locked it in. I refinanced, and I did a 4% mortgage, okay? And then I refinanced again, got down lower, all right? So that's something that you could do. Maybe you got a credit card, and it had a 12% interest rate, and then you found another one that had an 8% interest rate, so you moved it over. It's the same kind of thing, only interest rates are going up, and you're saying, okay, what helps? CDs, money markets, annuities, bonds, all of these things are going to look more attractive when the interest rates are higher. So you might want to consider getting out of something old and moving into something new. And that's a conversation for you and Mark together, to sit down and kind of analyze what you got and how it's working and how it might not be working. Give Mark a call. Here's the number. It's 984-300-1984. It's a no-cost, no-obligation look at your retirement. What does that mean? That means it's really a conversation. Here, Mark, this is what I've saved. I want to retire in 2 years. This is what we want to do. Here's my monthly expenses. Here's what my tax returns tell me. I got to write a check to Uncle Sam every April. Okay, let's get all that out on the table and figure out how a retirement plan can help you smooth over some of those bumps into retirement. Here's the number again, 984-300-1984, 984-300-1984, or more2retire.com. Okay, so this was kind of fun. In the early 80s, they did a study and they asked people, rate your driving skills. 93% of people said that they were above average drivers. Mathematically, that's impossible. That can't be true. All right. Similarly, last year, there was a study asking people to rate their skills on planning their own retirements. 67% of people said that they were confident I could do this on my own. Perception isn't always reality. So let's talk to the do-it-yourselfer, because I think there are a lot of different kinds of people that listen to these shows. Some have a financial advisor. They're looking if they're missing something. Some don't have a financial advisor. They want to start from scratch. Other people are doing it on their own, and they're just kind of cluing in here going, I wonder if I'm missing something. I wonder if this guy's got something to say that might be kind of interesting. What would you say to a do-it-yourselfer who comes in and you don't know if they're really there other than to get a pat on the back and saying, you're doing a great job? What is it? What's the conversation look like? And what do you see that people neglect or get wrong as they come through your doors?
I just tell them, don't waste my time, do it yourself.
All right. There's got to be more to it than that.
There's definitely a little more. But I mean, you're either going to try and fool me or fool yourself. But if you're a DIYer and you really just want my stamp of approval, I'll probably be able to give you some stamp of approval. But most of the time, DIYers will bring in their portfolio, we'll run a report, and I'll say you could do this, that, or the other differently. Mm-hmm. And if you're a true DIYer, you will leave, shake my hand, and say, okay, I'll go just do it myself still, right? Fantastic. Great. But if you're getting to that place where you don't want to do it yourself anymore because you actually want to retire, do other things, not feel like this is what you have to do to pay attention to your retirement for the rest of your life, well, I'm here. I'm available. I'll run the report. I'll answer your questions. If you ask me to do something or affect a transaction for you, I'm going to do it. That's what I do for you. So if you're out there and you want to make a difference in your life about taking some things off your plate, I've got plenty of people you could talk to as a reference point for you to know that if you ask me to do something, I'm going to do it. You ask me to build an income plan, I'll build an income plan. You ask me to take a little more risk in a position, I'll help you take a little bit more risk in a position. You ask me to dial back on some areas, build up a little bit more cash in the account. Fantastic. Okay. We'll do all those things. You tell me you love annuities. Great. You hate annuities. Great. We'll work through all of that stuff. I'll tell you the good, the bad, and the ugly about all of those things. But I also have a system for annuities as well. So if you have questions about annuities and you just don't understand why people love or hate annuities, well, I'll just share all that information with you. It's all on my portal. I pay for that service, but it's important for me to be transparent with folks. With regards to brokerage, we do public and private stuff. I've got a group called Market Guard. I'm one of 300 advisors that can use Market Guard. They're a bunch of chartered financial analysts that build some portfolios that are very attractive for folks that you can use before or in retirement, and we can build them and work with them. And then I can also, build lists of different ETFs and stocks that I think are really good, and we can build those into the portfolio as well too, because I like people to know that I'm not lazy. I like to look and see what's going to be best for my clients, and it matters to me. It truly matters to me. But if you ask me to come in as a DIYer and you want me to make you the most money possible, I'll say, okay, but it can't be for all of your money, because that's not what I'm going to do as a retirement planner.
I mentioned earlier that I saw that article, and I'll probably dive into that deeply next week, and that is, how people 5 years into retirement, this is where they start to see some of the problems show up, and that's when DIYers kind of go, uh-oh, didn't see this one coming, and a lot of times that oncoming train is taxes. They don't see the tax bill coming because that's about the time the RMDs take place. And now you're taking all this money out of your 401k and it's throwing you into a higher tax bracket. And oh boy, the tangled web that is. And sometimes that's that oncoming train that Mark can see. And he says, okay, we're going to have a problem here when you start taking RMDs. Are you prepared for that? And these are the kind of things that can come out of those meetings to say, okay, let's look down the line just a little bit here and see if this is going to be sustainable. Give Mark a call. Let's go through that exercise. It's no cost or obligation. Let's take a look at what your retirement looks like, and not just for next year, but for the next 5, 10, 15, 20 years to go. 984-300-1984. That's a no-cost meeting. 984-300-1984, or use the website, which is more2retire.com. A lot of people will listen to these shows. They'll see things on TV. They listen to some of the national people, and one of them is Dave Ramsey, and he's on a lot of radio stations all across the country, and he comes right out and he says this whole idea of the 4% rule of taking 4% off of your investments is stupid. He comes right out and says it. He doesn't like it. But what he says in return, I don't know. It kind of doesn't look right to me. He says you can assume in your retirement a 12% return. You can withdraw safely 8% for living expenses, and then the remaining 4% will grow and combat inflation and grow the principal. And I thought, 8% withdrawal, 12% on the assumed return. Those are some pretty big numbers, Mark. I would say if somebody were to walk in and they say, this is my plan, would you say that they're headed for trouble? It just doesn't look good to me.
That's a classic case of using a wealth advisor, thinking about making the most money possible on your money, and then just taking withdrawals from that money.
Okay.
If we have a correction in the market, you're going to think differently, okay? If we have a recession, you're going to think differently. It's not going to feel like that. And then the other part, and we've talked about this before, but, Dave Ramsey's worth quite a bit of money.
Yeah.
And I don't think he's able to relate in this case, all right? This is a little different here. This is a different ball game, but if you tell me that I'm going to go ahead and have you expect, no matter what, a 12% return and 8% distribution withdrawals, and say that is a certainty, that's crazy to me. Okay, I can't do that. We do have some market things that we can do that have very high distribution rates and a little bit lower volatility, but it still has volatility. Okay, still has volatility, which means it's not necessarily in the bank.
Yeah,
all right,
it's not guaranteed.
So there's volatility.
Yeah. Well, one of the things that you've mentioned about Dave Ramsey, and I agree with this, is a lot of these people who are on the radio in that vein, who are national, they're not financial advisors, they're not licensed. And that's how they get away with saying pretty much anything that they want to say. And one of the things that I dislike about some of these things, and you mentioned it, is they are in such a different strata of life, is they do what I refer to as shake your finger radio. Is Susie Orman looks at you and says, don't you go out to dinner so much. It's killing your retirement. Don't you buy that $5 Starbucks. That's killing your retirement. I hate that. I just hate it. I mean, my wife is now retired, and she looked at me the other day and she goes, I don't want somebody telling me to do that. I'm going to be sensible, but don't tell me I can't go out to dinner. And that's some of what I hear from some of these national people is don't do this, don't do that, don't do this. What I hear from you is here's how we can help. Here's what you can do. Here's how we can get you to a successful retirement. And it's not shaking your finger.
Right. And we're not saying anything bad about Dave Ramsey or Susie Orman because they're both very intelligent people. What we are saying is that if they make a recommendation or they point you in the right direction, they're making money. Okay, they're making money off this stuff. All right, we already know this. They can go off to Honolulu right now if they want to. The bottom line is, if you're coming to me and if you want to have a conversation about retirement and you want to talk to a normal American person that loves this country and wants to take care of you in retirement and make sure that you do the things that you want to do in retirement, make sure that when you pass on, that your beneficiaries receive their assets the way they're supposed to, that you can work with somebody that can work with the next generation when it comes time, whether you have cognitive impairment or you pass away, and you make sure that your estate planning is done, you've worked with the attorneys, the CPAs that I've passed on to you. I'm the person that can help you do those things. I will be there like a family member as needed, based on when I'm contacted or asked to do something. Because if you ask me to do something, I'm going to do it. And that's the point. We're a family here. So you come into the Marc Oslar Retirement Experience, you become part of our family. We care about you. We want to make sure that we're affecting your lives in a positive way. If I'm not affecting your life in a positive way, you need to tell me, because the bottom line is we want to help in here and we want to help you retire. And it's not going to be based on thinking about how you can make 12% and pull off 8%. Maybe there are some tax advantage strategies built in there with some groups we work with that have high distribution rates and maybe some really good returns. But that's not the focus of how we go about this.
One of the things about retirement planning is it's a little bit different than, well, there's two kinds of transactions. There's a transactional thing. That means you're going to go someplace, you're going to buy something, you're going to do something, you're going to get a service, and you're going to go out the door. And you're not going to see that person probably ever again. Mark, that's not the way it is with you. It is a partnership that somebody's going to sit down with you, work with you, get them to retirement, but then get them through retirement, because stuff's going to happen over the next 15, 20, 25 years. And there's going to be some ups and downs in your life, and there's going to be ups and downs in the markets and all sorts of places. And you got to help them navigate through that. And that's one of the reasons that you're there. This is more of a journey together than it is a handshake and out the door, and I hope it works out for you.
That's right. And that's the point. So another advisor, I talked to a very successful advisor. He has his business for sale right now, and we were just talking about different things. And he was like, that's the difference between our thought processes is these other advisors are thinking about the transaction, and I'm thinking about the relationship. Mm-hmm. And if they value me as an advisor, they're going to take my advice based on the situation. But at the end of the day, the client is always the person that's in charge. So I'm always going to have advice. And you don't necessarily have to do what I say, but we're not in a business of transaction. We're in a relationship business, and we're going to give you advice based on what we see, based on what the experts say, and what we can identify about certain factors. And what's important to us is preservation, income, and growth. Preserve what you worked your whole life for income tactics to be put in place for preservation. Make sure we're prepared for taxes and inflation. And then we can grow everything else effectively with the market with time. As long as you have time, we can grow it and not have as much worry.
You're listening to the Marc Oslar Retirement Experience. Online, it is moretoretire.com. You want to sit down with Mark and kind of talk through this and say, okay, Mark, here's what I've done for retirement. What does it get me? It is, how am I going to get paid? How am I going to navigate all this stuff that I've got to figure out, like Medicare and Social Security and legacy planning and wills and trusts and all these different things that I need in this portion of my life? That's a big step. And to get a guide to help you along the way, could work well for you. Give Mark a call. MoreToRetire.com is the website. 984-300-1984 is the number. 984-300-1984. All right, so one of the things that I said, things come up, along the way. If you're on your way to retirement and you kind of got a plan, you're 64 and you say, well, I'm going to retire when I'm 67. I'm going to get to my full retirement age. I'm going to get my Social Security and away I go. Well, a lot of people don't get to do that. They don't get to retire on their own terms. There's a study out there that's been ongoing for a long time, since 1992, and they're following 20,000 people. When they turn 50, that's when they start following them, and their goal is to follow them financially and everything else for the rest of their lives, from the time they turn 50 till they pass away. And one of the things they have found with people is once they turn 50, more than half of these people have lost their job either in their 50s or their 60s for whatever reason. Sometimes it's voluntary, that they got to go take care of a spouse. It's their health. Something happens. Or they get downsized. Their industry goes flat and something happens like that. This is an example, Mark, of something that can happen to you along the way that, hey, I thought it was going to be this, but somebody threw, a wrench in it, and now it's going to be this. What do I do? So bottom line is to have a plan to work to 67, but if something happens along the way, we've got a plan for that as well. Mark, can you build a plan where you say, I'd like to go 3 more years, but if I can't, can you get me out in 1 more year? That's got to be a part of the planning process.
Yeah, and part of it is risk versus return. Mm-hmm. Part of it is, could you do it without the risk? Those are the questions we have to answer. Yeah, I can answer those questions. I mean, I have a client that got laid off, and we were able to help her retire a year later, just simply because that's what she needed, right? Mm-hmm. She needed to maybe not look for another job. We did that ahead of time. We looked ahead of time. We said, okay, this is what we can do. If we prepare. We prepare our fields, like the Bible says. If you prepare your fields, you're going to reap a harvest. And so this is what we need to do ahead of time. Another client of mine was like, hey, Mark, I really, when I hit 59 and a half, I really think I want to retire. I say, look, okay, we're going to have to take some bigger withdrawals from now till 62 when you can turn on Social Security, but this is how it can work. And these are the conversations we're going to have. So yes, if something happens, if something changes. I had a conversation with a lady the other day who was laid off, and she wants to get another job, work for another 5 years. And I told her, I said, I think based on your asset level, there's a good chance that if you really did want to retire, we could probably figure out a way where you could retire as well right now. It just depends on what you want, what you're looking to do.
Nice.
And I want to affect people's lives in such a positive way. You come back to me and say, yeah, I want this relationship. I want to work with this guy, and I want to work with you. I want to show you how I can be a good part of your life, and I can help you in a lot of other different ways. And what are the other ways I can help you? I can help you prepare your entire process between the estate planning with the attorneys, communicate with your CPA. I mean, a client that's been a client of mine for years, she asked me to speak at speaking engagements from time to time, and she asked me to talk to her CPA. They got their lines crossed, and take the client, phone call, explain the distribution, explain where there was nothing in the taxable box, why, so on and so forth. I'm not answering tax questions. I'm just producing the documents, information, and have a conversation. What we do best as financial advisors is making sure that if you ask us to do something, we do it, but we also help you retire properly, and we use preservation tactics for the income. And that's really what's really important to us. And we will, if you ask us to grow your money, we will absolutely grow your money.
Well, one of the things that you can do right now is go to the website, which is moretoretire.com. There you're going to see the pathway to more. And basically, when you call Mark, that is the process that you'll go through. It really just starts with what he calls the treetop view, where we sit down and talk about who you are, what you want to do, what you've done to save for retirement. What does that get you? And then the real work begins. You go off and you do some stuff, and Mark sits down with the team and really starts to crunch the numbers. And at that second meeting where you sit down there and talk through some of it, then it really starts to come to life. And then as you go through your retirement together with Mark, as these things come up, you've got a plan for it. Give Mark a call. Let's talk through your questions, your concerns. Here's the number, 984-300-1984. 984-300-1984. It's a no-cost, no-obligation look at your retirement. Really a conversation. You can find the website at moretoretire.com. that is all the time that we have this week. We hope you enjoyed the show. If you missed some of it, it's on iTunes and Spotify. Check it out there on our podcast. And we will be here next week. We hope you will be too. Have a great weekend.
Insurance products are offered through the insurance business Marc Oslar Retirement Experience. Marc Oslar Retirement Experience is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Marc Oslar Retirement Experience are not subject to investment advisor requirements. Investing involves risks, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying ability of the issuing carrier. This radio podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be considered as advice designed to meet the particular needs of an individual situation. Marc Oslar Retirement Experience is not permitted to offer, and no statement made during the show shall constitute legal or tax advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein are provided by third parties that have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Marc Oslar Retirement Experience. Market Guard is a firm that provides investment signals as well as portfolio allocation recommendations for a wide variety of model portfolios. Market Guard does not offer advice or enter into fiduciary relationships. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.